Alright, welcome back guys to MMG. Let's talk about the news in the markets. It's been a while. First of all, not financial advice. Consult your licensed financial advisor. I'm not a licensed financial advisor. This is more of an educational channel, trading, and listening to me talk about economics and giving you guys my opinions, which could be wrong or right. Alright, so the market finally pulled back a little bit, and it is a dip as of now today. It will I think it's going to continue to drop. So I'm going to do TA once I get through the news. But this is the S&P 4-hour chart. Huge drop because of the trade war. Well, because Trump said we'll come to an agreement in 2020 or after, or not 2020, but after the elections, like in a year, which is a very long time. A lot could happen in a year. Either way, things looking not too shabby for next year. And I'm going to talk about this chart. This is the S&P, and this is a 6-month time frame chart. Nobody looks at, but fairly accurate for the last two recessions, right? I'll talk about that in a sec. But and then I'm going to talk about the news and then the repo market. There's a lot to talk about, so I'm going to freestyle this a bit. So what's the first thing on my list here? I have a bunch of tabs open. Most of this is from Zero Hedge. You know, a lot of people don't like Zero Hedge, but their articles, most of them are from other people. They just publish them, and they publish things that the mainstream media sometimes publishes, but doesn't like put on their headlines. Doesn't put on their first their covers, right? Or it's not the first thing on their main page, so it's hard to find news. All right, so title: forget the economy, the election, the strength of stocks as the nation's great unifier. So people, for the holiday seasons, they're coming together, family members, this and that, like for Thanksgiving. And the one thing they could all agree on is the stock market's doing great. It's been going up, right? So let me read a little bit of this. You won't be hearing any central bankers talking about asset bubbles, especially in December, but you will be assured that the favorable financial conditions are good for one and all. We have room to do more. Isn't a favorite punchline because of anxiety over the prospects of an upcoming non-farm payroll data. So I'll talk about the non-farm payroll data. I was reading a research report this morning which laid out the issues they thought would be front and center in the U.S. presidential election, blah, 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 especially during the debates. So keep in mind, as the elections come up, the economy is going to be, it's all about the economy, stupid. And that's what most voters care about or should care about. They do. Although, all this divide, a lot of people become emotional, and it's a circus. It's a show. It's a show. That's why don't waste your time, guys, with politics. It's a show. In the end, you never even know. Like it could just be a show to keep people from paying attention to the real issues, right? Although I do agree that the left and the right, they want to get rid of the orange man, right? So because although it could be a show, I don't know. Anyways, over the holiday, I was fascinated by 3 separate conversations. They were certainly instructive. The one was on a farm where everyone vowed to being a staunch conservative. Another with the lefty and mixed affiliations. So here's the thing. I don't want to say certain words because the algo is going to pick up on like all kinds of words, and then But I think they're talking about how the left has multiple mixed feelings about the people they could possibly vote for. And lastly, a table of New Yorkers who claim one and all to be committed lefties. In each case, the strength of the stock market was the great unifier and the popular subject of discussion. So here's a chart, the S&P going up, up, and away, right? But then here is the ISM composite, which is the manufacturing base of the U.S. And you can see the huge divide here. I mean, historically, the ISM composite runs similar with the markets because financial markets are based off of the real economy. Well, they're supposed to be. Of course, they're not because of central banks, right? So, because all the cheap money and credit creation, now we have the market's going higher despite bad economic data that's been coming out for months. And what does that tell you? So this divergence is, you see these at peaks of market bubbles. They just ignore all bad news. But eventually, these two lines, right? The red, which is the manufacturing base, and then the equity markets, they're going to have to line up again. You're going to have equilibrium, or the markets cannot go higher and higher on bad economic data, hoping that the Fed will keep lowering rates and then printing endless money, right? Because that's why the market's been going higher, besides all the tweets about the trade deal. Like, it's insane. Where was that? Look at this. So this was December 3rd. Today is December 5th, right? It's late night. It's right after 12 a.m. So December 3rd, update. 3 Trump says China trade deal might have to wait for 2020 election. Then the market dumped, right, last week. December 4th and Monday. Today is, technically was Wednesday, right? December 4th. Trump says trade talks with China going very well. The next day. And then what happens? The market, what happened? I mean, it's pretty insane that it's still working. This has been going on for like, way too long. But here's the S&P. So Trump said trade deal has to wait till the 2020 elections. Market dumps and crashes. Either way, it was going to do it anyways because of TA. And my technical analysis on the markets does work. It's been working for years now. If you've been following me long enough, you know, I might call things a few weeks early, and if you have patience, it's going to work out for your benefit. It's always better to be early than late. It's better to be 2 weeks early than 1 day late, all right? Because on corrections and when the market falls, it falls fast. Remember, the market takes the stairs up, right? These look just like stairs. Look at that. Little stairs. You have a little dip, stairs, and then straight down. Of course, Trump put in a bottom with his tweet, I guess. Everyone's wondering, how are people falling for this? Well, it's called complacency. If everyone thinks that everyone else is going to do it, they're going to do it. Or it's maybe a combination of that and the algorithms, the algos on the markets. The algos they're honed in onto Trump's tweets. They read them. As soon as a positive tweet comes out for the markets, the algo buys. And that's not a free market, of course. So yeah, the ISM manufacturing completely detached from equities. So what's next? Black Friday is dying. Shopping malls turn to ghost towns amid online shift. So yeah, that's been happening for quite some time now. Retail sales from brick and mortar stores have been falling, uh, but so has industrial production. You have to understand, less retail stores, the less construction, less building materials, less jobs for building buildings for retail stores, and it's going to have some pressure and effect on the industrial base. But yeah, if you've gone to a mall recently, and I'm not talking about those big malls that are really popular and people just love going to them because it's like a nice place to go. I'm talking about malls that have been around for a while, just in your local area. Not the supersized malls, but the smaller to mid tier. They have been struggling. And matter of fact, if you look, their parking lots are all filled with used cars because there's an auto bubble as well, right? That's where all the dealerships are storing their used cars. And there's a lot of, I mean, where I live, it's everywhere. I see it. All right. So what's next? Has the Fed Reserve gone woke? So much for the Federal Reserve being an independent institution free of politics. Yeah. So Kashkari, Cash Me Outside. um, he recently spoke last week, and it's pretty ridiculous. I mean, this guy's promoting. He's talking about the climate. He's talking about the acronym, the letters. I don't want to say it, guys. They pick up on that stuff. And if you haven't noticed, they're purging channels, like left and right, especially coming up for the election. So, I have to be careful of the words. Um, but let me read this. But Fed Bank of Minneapolis President Neil Kashkari, who keeps parroting the fallacy that the central bank is politically free, believes now is the time that the monetary uh, odds another objective to its policy manual: redistribute the wealth, baby. Isn't this the work of those esteemed representatives on Capitol Hill? Basically, in a nutshell, he's pandering to the left. So the left gets on board with the MMT. And you hear a lot of the lefty candidates talking about MMT. And what is that? Well, it's it's the central bank printing money, helicopter money, and instead of bailing out the institutions and Wall Street like they did in 2008, they're just gonna dump money on everyone, like you know, welfare for everyone. Everyone gets $1,000 check every month or something, which is insane. It'll just cause inflation, and then the money is gonna be worth nothing. And that's how you get the crack up booms, and you end up like Weimar Germany, like Zimbabwe and Venezuela and all them. That's how you end up carrying around a wheelbarrow of cash. So it's great for us, right? For the private members of MMG, our stocks are gonna explode in value. Hopefully, it just doesn't turn into hyper inflation. At some point, it might, but hopefully, this will happen slowly, like maybe 5 years, 10 years. I doubt they could do a 10. I'd be surprised if they could do a 5. Let's say the next 3 years. Well, it all depends who comes into power. But Trump is all about the Fed lowering rates to negative and printing as well. So the best odds are we're going to see inflation increasing steadily for the next 3 years. Then it really ramps up once the stock market dumps, which is probably next year. But the inflation, where it's really, really noticeable, will probably rear its ugly head after 2020 and 2021. Inflation will steadily increase for the next few years. But for the U.S., I'm only talking about the U.S. The rest of the world, I don't know. You're screwed. But because the U.S. is the cleanest shirt in the dirty hamper, right? So people are still going to be demanding dollars and buying dollars abroad, internationally, globally. So we're not going to see hyperinflation at first. At first, the dollar is, out of all the fiat currencies in the world, will be the strongest, but it's still going to be losing value nominally against real things in the world, like your utility bills and everything, right? Groceries and everything else. So there's a lot of moving parts. Also, when the markets fall, that tends to try to create deflation because money literally goes, it just gets wiped out. Debt just gets wiped out. People, when people default, when entities default, that money disappears from the system. So it's actually deflationary. So the inflationary deflationary argument, that's a whole separate video, but I do think at first we'll have somewhat of a deflationary event, and then it's just gonna all of a sudden turn into inflation and then hyperinflation. And I don't know how fast this stage is gonna happen. I just know it's gonna happen in that order. So metals are gonna go up through this entire scenario, through the entire time, except for one short period where the market really, really tanks. That's a whole nother separate video I'll make later. All right, but either way, what I'm trying to get at with this article here is this. Look at his head. It looks like a ball sack. So I shouldn't have said that. Anyways, he's getting the public ready for MMT, modern monetary theory, which is helicopter money, you know. So, and the public's likely going to go with that because they're dumbed down from schooling. So they're like, ooh, I get a check every month. Or, you know, they're going to inject money because the banks aren't lending to your average. They're not lending as much anymore because of the credit cycle to your average person, because your average person is swimming in debt. No one wants to lend the money. And if the bank does lend the money, it's like a ninja loan. It's like the mortgage-backed securities, right? With extremely high interest, variable interest, and then they slice and dice and sell it to some other bag holder. And that's how you get a global financial crisis like in 2008, right? Why the U.S. job market is about to crack in 8 charts. Citi U.S. Eco Surprise Index. So that's been falling, with the U.S. economy once again rolling over as various Fed and now casts see a sharp slump in fourth quarter GDP, and the Citi Economic Surprise Index slumping from a nearly 2-year high hit the start of September. So that's one. While real GDP growth is tracking the ISM lower month after month, which I just talked about that, right? So real GDP growth is also falling with the ISM composite. And what have I been saying for years? It's not about retailers and spending. That's not real economic growth. That's temporary Keynesian growth from cheap money and credit blowing, right? Bubbles. What is real growth is your industrial base. Your, your industrial base, infrastructure and construction. Downside risks to employment. So as you can see right here, last time it started falling like this, below this mean of 0, well, we get a recession. So another indicator, the non-farm employment, right? So unemployment's actually starting to tick up, even though everyone's getting more and more part-time jobs. I didn't know I could blow it up that big. Alright, what's next? A China trade deal just finalizes the divorce. So beneath the euphoric hoopla of a trade deal with China is the cold reality that The divorce has already happened, and any trade deal just signs the decree. So a few months ago, I made that video. China, there's not going to be a trade deal, and that's turning out to be correct. Again, any trade deal is like closing the barn door months after the horses left. Corporate America's supply chains are already leaving China for lower cost, friendlier countries, and for its part, China has already made its intentions to escape the grip of the US dollar abundantly clear. So, what I want to point out is, like I said, no one wins a trade war. So, yeah, American companies are leaving China. But where are they going? Are they coming back to the US? No. Regulations are too high, so are taxes. And there's unions in the US, right? So they can't afford to come back to the US still. The only way that can happen is if government shrinks, and so does regulations and taxes, right? You can't win a trade war with an increasing regulatory and increasing size of government. You just can't. So these companies are still going to stay abroad. They're just going to move around abroad, go to Taiwan or somewhere. As for supply chains leaving China for good, have you examined the labels of consumer goods recently? What once invariably read "Made in China" increasingly reads "Made in blah blah blah." The reasons are numerous. China's labor costs are soaring. Many other countries have lower cost labor forces. The welcome mat for foreigners has been pulled away. If you need evidence, look at the swelling flood of expats leaving China for good, an exodus that began years ago. Yeah, so capital flight and the corrupt elite from China have been leaving just for years now. That's another reason why I think China went into Kong quicker than, it was supposed to be in 50 years from now, not now. Anyway, China's, by the way, remember when I don't say full words, it's for a reason. China's workforce is shrinking as the populace ages. By the way, China has a huge demographic problem. They had the one-child policy, so they all had boys. I'm not sure what happened to all the girls, but they can't reproduce because there's not enough females in the country. Now imagine what's going to happen in China when their economy really, really starts deteriorating to the point where people are really getting angry, and it's just a bunch of now I wouldn't say middle age, they're like millennial age, like 20s and 30s men who can't even, don't even have women. All they could do is go out in the streets. It's going to be interesting to watch that empire go through that. China's repression of certain people, and you guys know who. That's another reason why the U.S. Can't morally and ethically do business with China, even though Europe is. In Europe, their centralized authority always is about human rights. But when it comes to China, nobody's about human rights. When it comes to climate, no one says anything about China or India, right? It's because the elite make money off of them. They've been using them. That's why they built them up, to make money off of them. And then they sold out the West, invested in the East, and made tons of money off of it, right? That's why they don't talk about it in a bad light. Imagine what would happen to Apple's reputation, right, if they stayed there. Even though the lefties, who are all Mr. Moral, right, which they're not, they're exactly the opposite. They just hide behind it. They love these companies that have literally slave camps there. It's funny because Apple and these companies that are the most human rights, they talk about human rights, are so-called woke, and have these commercials. They're the ones who have the slave camps in China. It's hilarious. But your average dumbed down person can't put two to two together because they watch sports and everything else on Netflix and, fill their heads with nonsense. The tide of Chinese students studying has also decreased. Chinese corporations are increasingly reluctant to invest in the U.S. China's share of world exports, percentage-wise, is actually starting to really drop. So, China was the growth engine in the past decade of the world. No longer. No longer. Now, the question long term for the next few decades, will China reemerge as the strongest after this global financial crisis we're about to go through? We're actually in the middle of it right now, guys. That's why we have the repo market happening, but I'll talk about that in a second. But we are in the midst of the collapse. People always think it's gonna be like a 1 week thing or something, or you're gonna wake up one day and oh my god, it all crashed. No, this thing happens slowly, and then there's gonna be a few months of where equities finally start crashing and people start getting laid off, but prior to that, there's like a whole year or two of things deteriorating, and then finally people waking up and pulling their heads out of their rear ends, right? Because right now we're in complacency at all-time highs, near all-time highs. And this might be it. I mean, this might be the high for the markets. I think there's a high probability of it is. The only reason I say I'm not certain is because I don't know if when the Fed and the central banks come out and lower rates to zero and start printing, will the market actually shoot straight back up and it will have a crack up boom type scenario? That I do not know. I'm just saying that's another scenario. So I don't want to say that this is the top. If I knew that the Fed's manipulation tactics wouldn't work the next time, then I would say it's the top. All right, next article. This is going to be a long video. I try not to make long videos, but it's been like 5 days since I made a market video. I'll talk about gold as well. Gold's been ripping higher. By the way, the link's in the description below. 15% off for the private group. I research gold, silver, junior mining stocks, and royalty companies. Really, real downside risk and all the upside potential that can change your life. And I understand everyone's strapped for cash, and it's the holiday season. You got to buy gifts. But yeah, 15% off until the end of the year. China braces for December D-Day, the unprecedented default of massive state-owned enterprises. So 3 days after the described self-destructive doom loop that is tearing apart China's smaller banks, where a second bank run took place in just 2 weeks. So listen, the banks, I listened to another podcast, Wall Street for Main Street. That guy's like, I really like him. Who else do I like? I like Peter Schiff. I like Mike Maloney, and I like just escaped me. The dollar collapse. John Rubino, that guy. Those are my favorite guys. They know what they're talking about. All right. So yeah, I mean, Chinese banks are just blowing up left and right. And like I said, China right now is in worse shape than the U.S., and the trade war is really about that. Because they're the next emerging superpower, and Trump knows that. He also does need to remanufacture the U.S. So he also knows that a lot of capital flight will come out of China into the U.S. and the U.S. stock market, which temporarily, short term or to midterm, which is weeks and months and a few years maybe, will help the U.S. It's economic warfare, guys. Next article. So 30% of Americans think the dollar is backed by gold. and other absurdities this week. By the way, guys, if you guys want to read these articles, just type in the title and you'll find it. because I'm not going to cover every little detail about these articles. Really, 30% think that? That's your education. That's your public educational system, right? So, despite the fact that public education is lacking, the government thinks that it is the parents who should have to prove themselves if they want to homeschool their own children. Yeah, guys, homeschool them. Everyone used to make fun of those kids. Those kids. I mean, it all depends on the parents, right? There's a reason why I don't have kids yet. Um, and I want to have kids. I want to have a lot of kids. I just need to make sure I'm in the right place when I do that, and I'm financially loaded, right? So, you know what is exciting? I don't want to be a Debbie Downer, but there is some good news for the for humanity. If you have money, um, you could definitely put off aging and live much longer. Like, there's a reason why these celebs just don't seem to age. I mean, stem cells. And I'm not saying there's ways to get those. You could grow them in a petri dish, but if you're rich enough, you can inject yourself with those, and it definitely keeps you younger longer. You know what? I'm gonna make a separate video. I do have a third YouTube channel, and I want it to be about self development, self help, and all that. I've read hundreds of books. I've like hundreds of audiobooks that I've read, and I educate myself like 8 hours a day every day. It's like nonstop. It's become a habit and a hobby. I don't know how much of it I retain. My memory's still not that great. I did party a lot in my 20s. Um, but I'll make a separate video on that. There are some new developments that have come out. Let's talk about the repo market. Or wait, there's one more China thing. And then we'll talk about the repo market. Oh, there's a few more articles. All right, China set to make history with record number of bond defaults. So bonds are defaulting. Corporate bonds. Yeah, if you guys think there's a huge credit and financialization of the U.S., China's done the same exact thing, possibly worse. So there's a reason why there's been capital flight out of China. What's next? Blaine, speaking to investors, it feels that confidence in the Trump narrative is breaking. So Blaine's morning parage submitted by Bill Blaine. Speaking to investors yesterday, it definitely felt like something is breaking. It's not about the China-US spat that is well understood. My clients are not stupid and understand how the mood in the Beijing has changed. They see the Chinese don't trust Trump, and they are increasingly confident of their perception that although he barks and blusters, he is unlikely to act or bite. That will inform their political choices, including a response to Hong Kong and Taiwan. By the way, China really does not want Trump to win 2020. Just keep that in mind going forward. And a lot of these corporations in the U.S., they definitely want to tap that Chinese market, and they have been. And that's how you get like third columns in. You get an infiltration of a nation from within, and this has happened because of crony capitalism, right? So you understand what I just said. There's corporations that might be in hoots with the East, right? That's why they really want Orange Man out. Does it all come together now? See? All right. What's breaking is confidence in the current Trump narrative, blah, blah, blah. The market's concern is that the market narrative that driven stocks and bonds higher through the year is played out. It was based around two factors: that Trump will remain disruptive but a positive market force, juicing prices via tweets, tax cuts, and short-term fixes because his re-election depends on perception of economic strength and central banks will continue to positively distort markets via accommodative policy and monetary experimentation because they can't face the prospect of market weakness. So, despite all the bad economic data and all the volatility and the riots across the globe and other countries on the periphery, emerging markets, and even Europe weakening, U.S. stock market keeps going higher. And the reasons I just listed are the reasons, right? Which is, first one was tax cuts. Well, the first one was Trump getting elected himself. That was very positive for the market. Then the tax cuts. Then the trade war has been spun, and the way with his tweets has manipulated the markets higher. And then on top of that, the Fed capitulating and finally lowering rates, no longer hiking, and normalizing rates, but lowering them now for the past year. And then eventually the market thinks that this could go on forever. And they think the Fed and Trump and his tactics are going to keep the market going higher and higher. That's why everyone's become complacent. And then the central bank, right? But here's the thing. It's been going on for some time now, for a year, ever since that low from the beginning of 2019. So it's sort of getting played out, and I think investors know that as well. Like, this just can't keep going. The bottom line is we may be past peak Trump. For the last 3 years, markets have been collectively happy to coattail his actions, along with the algos. Although we're all privately concerned about the ongoing White House shenanigans, impeachment, you'd have to been foolish to not to follow Trump's market higher. What's not to like about the U.S. president willing to juice the markets with his tax cuts and blah, 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 trade deal and all that? Now every trader who played that game is looking around to see what the rest of the market still believes. Now here's the thing. As soon as the traders and Wall Street investors look around, they realize, all right, the party's over. The tactics aren't going to work no longer. Guess what? They're going to go from long to net short. If everyone walks away at the same time, then the market is potentially in trouble. Yes. There is the possibility of a rising inflationary threat as credibility of the government is roiled. Again, as we go into the elections, investors are going to, as we get deeper into 2020 and the possibility of a lefty winning, that's also very negative for the markets, besides the negative economic data and a whole bunch of things. I mean, the repo market, if that's not a red flag, I don't know what is. It's people are going to look back on this and they're going to say, how did you not question what's going on with that? Anyways, we're going to take a look at that in a second. So what do we have here? Is something going wrong? Something broken? Quants running scared as nothing makes sense. Right. So Exhibit 18, a sharp turn for global central banks. So interest rates across the globe are just being dropped by central banks. And that's the short-term interest rate, the overnight, right? Another reason why we have repo madness now. So the world index is just shy of its January 2018 highs, and the S&P has returned an impressive 24% despite the jittery start to December, and stands at all-time record highs despite, paradoxically, a year of record equity fund outflow. So the only thing keeping the markets going up, I think, is foreign capital and corporate buybacks. Meanwhile, hedge funds are actually selling right now. The smart money getting out. Hedge funds have seen outflows every month this year except February. See what I mean? Look at this chart. Smart money's getting out, guys. Retail investors are going to be holding the bag. And pension funds and foreign investors. But especially for quants. All right. So, look at this chart. Exhibit 37. Correlation between factors is extremely elevated Incorporates 9 factors including growth, value, size, dividend yield, momentum, and volatility. Look at this chart. I haven't seen a chart like this before with using all those factors. Well, look at the last time this thing spiked as it did recently, right before 2008, 2009. So, what was that chart? Valuations have been falling while valuation, equity, factor, performance, low versus high. We'd have to look at that. So, the average realized pairwise correlation of our factors has reached levels only achieved twice in the last 30 years. In the second quarter of 2009, as the equity market bottomed in the financial crisis, and in the first quarter of 1997, right before the tech bubble popped. Yeah, guys, the everything bubble is... We're getting close. And I told you guys last few videos, we're close. It's going to be 2020 for sure. That's another reason why Orange Man's probably not going to get elected. Gold has outperformed the stock market over the last year. Yes, it has. And I caught the very bottom personally in 2015, and then before the breakout to above 1300, or even I think it was below that. It was like 1240. To my followers on YouTube here and everywhere else on my other social medias, I've been saying now's the time to buy. That's why I rushed the website, the MMG website and everything, because I wasn't even ready. I was, So there was another gold article that was really important. What was it? Gold. Pull their gold out. I can't think of it. Hopefully it comes to me. Let's take a look at the repo market, shall we? So here's the 2019, the spike in repos. The same thing happened in right before 2008. Check this out. Look at this. 2004 to 2008, the repo market was shooting up, and it's been shooting up since 2016. Ironically, right when the Fed started raising interest rates, when Janet Yellen first time raised interest rates, and then Powell, then a year later, Powell came in and kept raising interest rates. So that's what caused the repo market. That's what caused overnight lending to break for banks. And they probably blew a bank up, and now they don't trust each other. So the Fed has to inject money into the freaking banking system. So how much have they been doing? So I looked at some numbers. Where is that site? Here's the site. So here's the repo in the reverse repo operations. So reverse repo is they take money back out. There's not a lot being taken out, but there's a lot being offered and put into the banks. Now, this isn't like the number of money they've taken on to the balance sheet, but since the 18th of last month until now, so 3 weeks, I was just looking at this. But they don't give you the entire data since they started. It like disappears. I'm not sure where to find that. Oh, it's probably right here. Historical search for repo and reverse repo operation. Someone else could do the math. But listen. In the past 3 weeks, 937 billion with a B has been injected into the overnight lending market. And then only like 113 billion was reverse repos. So money coming back out. So there's a huge divergence, right? Huge divergence there. There's like 800 billion that's being left for the banks, and then only 113 being taken out in the past 3 weeks. So 937 billion with a B. That's almost a trillion. Where's the chart? Like, if you stack $100 bills on top of each other, I think it'll reach the moon if you had 1 trillion. Something like that. Something insane. If you wanted to visualize it. Don't quote me on that. I'm not sure. I don't want to edit this video. It'll take me forever, so I'm just not going to look at that right now. I'll look at it next time. Maybe, but don't forget. That's insane. And I did the math. You know, I was doing some math. If someone is very, you know, they like digging deep into things, go and take a look at the historical and try to figure out how much is still out there on banks' balance sheets. That'd be interesting. Now, we could look at the Fed's balance sheet and look at this growth. So at the all-time high of QE, it was around 4.5 trillion, their balance sheet. And then it started falling in 2018. At the beginning of 2018, as the Fed started raising interest rates, it started falling. And the balance sheet started unwinding as they promised, which is normalization, right? And then all of a sudden, something broke, and we reached 3.7 trillion, and now we are back up at about 4.05 trillion. So, yeah. I think the market, there's no way in hell the market can ignore once the Fed's balance sheet gets back above 4.5 trillion. At that point, I think Wall Street might actually question if the Fed could do anything from stopping a, not a recession, but the greatest depression ever. The greatest inflationary, first it'll be deflationary and then inflationary, greatest financial economic crisis the world has ever seen, pretty much. When will that be, guys? I don't know. When they will announce it. We're at the beginning phases of it right now. So I wish I could remember that gold news I wanted to talk about. I cannot remember. Excuse me. Alright, so let's take a look at the charts. So I did have a 9 sell, the TDI on the 4 hourly. That worked out great. Worked out really great. But the markets have been closed last week and whatnot. So it's only been 2 days of markets. Alright, let's get to the big macro stuff. 6-month chart. The 6-month chart has been pretty accurate in the last 2 recessions. With the TDI and the heat map. And the countdown. I mean, yes, the dot-com bubble in the 2001, when we had that slight recession, it fell on the 7 count, but you know, the heat map, the 7 count, it's close enough to a 9 count. Once we get to a 9 count, then you get a sell-off, 1 to 4 candles or 9. Okay, so the last 2 recessions were a sell-off, 4 candle sell-off, with the 6-month time frame. This is the S&P 500 6-month time frame chart. Every candlestick represents 6 months. So, but it did fall on the 9 for the 2008 mortgage-backed security and global financial crisis. We're on a 9 right now. That's why I think soon, in 2020, or right now, it's either that or now's the top. We just saw the top to the market. And I just want to show you guys that. Big deal. Huge deal. Look at the RSI. Look at the momentum indicators. Look at all of the oscillators. All extremely overextended. It's coming soon. If this isn't the top right now. I'm just warning. I think this is the top because they really did everything they could for the market to stay at a near all-time highs and hitting new all-time highs for this Christmas shopping season going into 2020. So I think the top might be in. I don't want to say that because I don't know what's going to happen once they really ramp up the printing presses. But for now, it's in. Financials, they dumped. Here's GDX, gold ETF, one of the big ones that everyone knows about. Look at this beautiful bull flag, looks just like gold. So for the past 5 days, 1, 2, 3, 4, 5, we had a huge rally in the metals ETFs and the miners and for gold and silver. As I said, there would be, right? Now, it hasn't completely broken out yet. Let's go to the gold price. So here's a 31-day chart. Now, I do want to warn you guys. This is very important. If you made it this far in the video, you get rewarded, I guess. So let me remove some stuff here. By the way, I think just one person used my TradingView referral code, which is unbelievable. Guys, use my referral code. You'll get like $30 off, something like that. The holiday sale is probably over with now, but you know, you would have saved hundreds if you would have used my referral code. Oh well. All right, this is where I think we are right now compared to the last bull market in gold and silver. This is the price of gold, monthly chart. Every candlestick represents 1 month. This is the area we are in. Let me zoom in. Okay, this is where we are. Somewhere around this area. Let's go to current time. Now I have this bull flag and everything. So we are on a 9 sell for the monthly. Now, can it go higher? Yes, and ignore the 9? Yeah, it happens all the time. But this is what I'm thinking. I think gold's going to rally for the next few weeks, maybe a month or two. I'm not sure. We'll see how much the stock market falls. But if the stock market falls and then continues to keep falling and starts crashing like in 2008, then gold and silver will rally initially. And I have to warn you guys about this. It will rally initially. So I'm thinking it'll do something like this, right? It'll shoot up and maybe go to 1690, maybe go a little higher, and then it's going to crash with everything else if the stock market's crashing. Why? Because everyone's going to get a margin call and everyone's going to sell everything going to cash. That's what happened in 2008. And then the metals are just going to explode higher as the Fed capitulates again and just starts printing money like it, you know, it's going to be raining money, all right? We're going to get MMT, QE, 4, 5, 6, 7, 8, you know. And then metals are just going to explode higher. And this will happen quickly. This could happen very quickly. I don't know how fast, but it could happen within weeks, maybe even days. I don't know. So, you know, let me... So, boom. And then it's going to pull back. Now, if the market doesn't like crash or whatever, then this rally is still going to happen, but metals are going to pull back and correct in a really big way. So either way, metals are going to correct probably within the next few months. But I don't know by how much they will correct. So here's the deal. I mean, this month it could shoot straight up, right? Around 1680, 1690, and maybe even go a little higher. And then it's going to fall. And I don't know how big the pullback will be. It all depends on what the stock market's doing, what the bond market's doing, and all that, right? And the news cycle. So if you got in now, you still might be getting in at a really good price that you're not going to ever see again because you don't know how high this will rally. If the stock market starts really crashing and dumping, you never know. I mean, it might actually just keep rallying and rallying to 2,300, making new highs in gold. And if that happens, the mining stocks are going to explode in price. I just don't know. So I'm not a prophet, guys. I just take this day by day. That's how you have to do it. So I wanted to show you guys that. It's really important. So I'm going to end it here. This video is too long. Most people don't make it this far. If you made it this far, congratulations. And thank you. I really appreciate it. If you guys, watch all my entire videos, smash some likes, leave anything in the comment section, leave in the comment section what you want me to cover, and go to my website, 15% off, and go into my chat groups, because you never know when they're going to take me out, right? Of course, I'm posting on other platforms as well. All right, until next time.